Today we're discussing a crucial topic for expats with NHR tax status in Portugal, planning ahead for when the NHR ends. Now, a recent survey of wealthy expats in Portugal found that only 27% of NHR tax holders had taken steps with cross-border professional advisors during the first 7 years of their NHR status in order to mitigate the impact of Portugal's progressive tax rate once the 10-year period expires. Many have enjoyed the benefits of low taxation and only to find a shock when rates jump dramatically, often from single digits to 28% or even as high as 48%. This is due to a lack of long-term planning. One of the most well-publicized case recently involved a Swedish couple who were hit with a €180,000 bill in year 11 simply because they hadn't planned ahead early. The good news, however, is even if you haven't started early, there are still steps you can take to gain peace of mind and to protect yourself. Our expert panel today will be answering your questions throughout the hour-long webinar session on this subject. So please put your questions in the chat. And again, if we don't get to all of them today, our team will follow up with you directly to schedule a meeting with one of our cross-border tax and wealth management specialists who can support you in navigating this so that you're optimized before it's too late or a costly lesson. So without further ado, I'd like to introduce you to your panelists today. Firstly, we have Paul Stannard. Now, Paul is the chairman and founder at Portugal Pathways. Paul supports private wealth investors, entrepreneurs who are considering investments or relocation to Portugal. Joining Paul, we've got Niall McDonald. Niall is a partner at Beacon Global Wealth Management. He specializes in cross-border expert in financial planning, investment management, and tax alignment for affluent expats in Portugal. And finally, we have Joanna Marquez Alves. She's a tax partner at RFF Lawyers. And Joanna has extensive experience in cross-border tax planning. She advises expats on optimizing their tax structures within the international double taxation treaties with Portugal. Thank you guys for joining us today. So I really wanted to sort of dive straight into today's topic as it's really important to many people without them even realizing. Having NHR tax status in Portugal does not last forever, and people need to create a cross-border plan well in advance of the end of their NHR tax status so that they can enjoy life and have long-term strategies delivering returns, and more importantly, is optimized from a tax position before it becomes very costly. How can they continue to enjoy life in Portugal without the worry of a future tax burden after their NHR tax status ends? Now, Paul, you deal a lot with inquiries around this topic. Can you sort of share with us the main concerns that people have?
I think the main thing is, I mean, obviously anybody that's joining this call curious to understand more, but I think a lot of people don't think about it. That's part of the problem. They're too busy. They've had a change of life. They've moved to Portugal maybe for different life reasons, a slowdown in life, or for business reasons, and they're getting on with life. But they don't know it's the law of unintended consequences. And if you do leave it too long, the longer you leave it, the closer it gets to that 10-year window. The bigger challenge it is then in putting in strategies in place that can mitigate that. And there are things you can do if you act early.
Absolutely. Niall, I want to come to you next. I know it's a common thread and you can never plan too early, but could you give our audience why this is so important to people already eating into their 10-year NHR tax status? And so sort of what extent is this true, and how big a difference ultimately is it between starting your planning in years 1 to 5, obviously, rather than leaving it in years sort of 9 to 10?
Hi, Steve. Thank you for the question. Hello, everyone that's on the webinar today. one thing we're kind of talking about is planning. So for me, going back to firstly what planning is, it's to anticipate really what you expect is going to happen and allow you the opportunity to respond accordingly. In this case, it's important then to understand, well, what happens when the NHR period ends, and is there any, structures, is there anything in place that can be used which will help you mitigate that situation when that period eventually does end, which does run for 10 years, but as we know, it's been closing over the last few years, so more often than not, most people are eating into that 10 years already. Looking sort of beyond the NHR period, I know that Joanna will probably come in on what happens with regards to the Portuguese side of things, but in summary, it's a more painful situation than potentially what you've been used to really at the moment. There are vehicles there in place. That's what we specialise in. Understand there's quite a bit to that question, and I think maybe we'll cover off some more of that as the conversation sort of progresses. But I guess the key thing to take away is, can we respond to what's going to happen once NHR ends? And the answer is yes. And that there are strategies in place that if you can get them early enough in your duration of NHR, then, it can be quite significant with the savings post NHR period.
Thanks, Niall. Joanna, can you sort of add anything to that in terms of obviously the sort of eating into that sort of 10-year tax status and what makes a difference to do it early, plan early?
Yeah, it's true that planning ahead can make a big difference, and essentially because when we are thinking about any type of income that those taxpayers receive, if we compare with the general regime, we are considering income that will be subject to the progressive tax rate that we have. We can go further this matter later on, but it can make a big difference, like you were saying, between having the more benefit regime from the NHR, even considering zero taxation versus the progressive tax rates. And of course, there is something that we can do. And like Niall was saying, it takes time, and it's important to have this time to plan and to think, how can we restructure what we have now? And I think it's always worthwhile to do that and to think about that and have that kind of analysis. Because even within the general regime of the Portuguese tax system, we can find solutions that will grant a lower taxation. The key point here is that most of the time, this lower taxation is connected to having those type of structures in a specific way held for a long period of time. So this is why it's extremely important to have time to do that, to think about it. And well, to even if it's in year 7, well, let's start now, because it's important and can make a big difference in the future.
Excellent. Thank you. I mean, obviously, it's clear that failing to plan ahead could obviously mean a much sort of higher tax burden later on. And again, I just want to reiterate, as I know that we'll get questions coming into the chat, that obviously everybody is different. Everybody's set of circumstances is different. And obviously, we can't answer any questions directly within the chat today or on the webinar, because obviously they will be too specific. We'll obviously take those offline. People's lives can be complicated, and we know it's really important that you would need to have an initial discovery call, obviously, to understand that better. So again, you can reach out directly to us at Portugal Pathways, leave your comments in the chat, and again, we can set those meetings up and arrange those no obligations initial calls with the expert partners. Joanna, I mean, as a tax lawyer who works with lots of affluent international expats, how do progressive tax rates scale and impact if you don't obviously plan early?
Well, it's important to initiate to explain that the Portuguese tax system is based on a progressive system. So it foresees progressive tax rates to be applicable over the global taxable income. So we need to first understand which is this taxable income. But as a rule, and if we look into the higher tax rate that we have, our rates can build up until 53%. So that's a lot, and it makes a big difference when compared to the NHR. So even besides the applicable tax rates, it's important as an initial step to properly qualify the income. So it's different from other countries. So we need to take a look into our own rules applicable in Portugal and try to first qualify the income to then understand exactly what kind of taxation it will be subject to. If we, for instance, consider a classic case of NHR with foreign source pension income, and if we are thinking about old NHRs, we are comparing a 0% scenario of taxation versus the progressive rates that, as I mentioned, can build up to 53%. So this will make a big difference. And if we are thinking about 100,000, let's say, of taxable income, it's easily, the taxpayer will easily fall within the last tax bracket. And even besides that, we also have a solidarity surcharge. So it's all very detailed, very technical, but it can make a big difference. And in the future, let's try to avoid surprises and think and analyze how it would work for the future. So besides the pension income, we can also easily think about capital gains, and not only arising from financial assets, because as a rule, we have an autonomous rate of 28%, but in specific situations, we can also have this type of income falling within the progressive rate. So aggregating all the income received by the taxpayer, which will aggravate, of course, the tax bill due at the end. And also regarding property, so under the NHR, many of the clients hold properties abroad, and they will maintain that, maybe use them and to explore and receive investment income of it or not. But under the NHR, we are facing, again, zero taxation in Portugal in the future, and after the NHR, it's not the same. So it's a big difference, and of course we are considering here different jurisdictions, and we cannot forget that it's also necessary to analyze the double tax treaties in force. And we have a vast network. Portugal has a vast network of tax treaties in force, and this is what is going to allow for the granting of a tax credit to the taxpayer. So Portugal will be able to offset the amount of tax already paid at source versus what it's due in Portugal. So basically, as the NHR poses a major advantage for the taxpayers, and we are thinking about all different types of income, so salaries, pension income, investment income, rental income, because it is so much more advantage when compared to the general regime. It's important to have this kind of tax analysis with time to explain which will be the impact in the future and how can we avoid it. So what can be done trying to mitigate this impact and take the most advantage of the country and of our tax regime.
Excellent. Thank you, Joanna. Yeah, appreciate that insight. Obviously, I'm sure that this is a bit of a wake-up call to some of the people that we've got in our audience. But I assume that there are sort of strategies that can be put in place to mitigate this. I mean, Niall, could you talk a little bit in a bit more detail about this beyond what you've already shared?
Sure. So what we sort of predominantly do here is look at these strategies that are going to be in place for those that are post NHR. So during NHR, the people that will be benefiting from that no doubt will be familiar with the dividend friendly position, the pension friendly position, other income generating assets position. Well, all that changes with the ending of NHR. So our structure really looks at planning during that period. One of those things that we would look to utilize is what's known as a Portuguese compliant life assured bond. And indeed, that's one of the main vehicles that we see that works very, very well for those people that are really considering going to be in Portugal beyond that NHR period. This particular bond enables the client then to be fully sheltered from all gains. So it doesn't matter whether it's a capital gain, a dividend, again, an interest-bearing position, so long as it continues to reside within this particular structure, there is no gain. There's no tax to pay on any gains. So that is very, very simple, very, very straightforward. There is what I call a tax consideration, and that is when the client goes to make any withdrawals from a particular plan. And then again, I think we'll cover that off maybe in a little bit more of some of the questions. So that's one of the structures that we would look to utilize. I did see there was some questions then about a little bit more about the bond, and I will cover off maybe in an example later on, Steve, about how this exactly works. But there's sort of four main elements really that consist or comprises of the bond, or four main players, if you were. Obviously, one being the client. So they have to be 18, over 18, or under the age of 80, and Portuguese tax resident. There's the provider. So this is the life assurance company. Now they tend to be based jurisdictionally in major offshore centres, so such as Ireland or Luxembourg is some of the more common ones that we come across. You've got the investment aspect of it as well, which of course we haven't touched upon right now. It's very tax focused on the conversation, but one of the main drivers behind this particular product is the fact that you can have investments within it. So again, those investments would be unit trusts, mutual funds, exchange traded funds, passive trackers, individual share portfolios, or in some circumstances we've seen quite esoteric type investments. So you've got the investment piece as well, and then finally the last piece is the advisor. So that's what we do. So sort of ensuring the suitability and the recommendation of these particular structures, or indeed other structures for that matter, taking the client from kind of where they are at the moment, obviously during this NHR period, and where they're trying to get to post NHR. And that again could be utilizing this particular structure. One thing that's well worth commenting on as well, Steve, is the fact that the bond itself is actually very, very efficient for any succession planning and estate planning. Based on where the particular person is. It's not the purpose of this conversation, but we've got things to consider, such as domicile and residency, which I'm sure some people will be more familiar with, given some of the changes that are about to be brought into the UK. So the bond really offers a really, really tax efficient route for post NHR planning and indeed succession planning as well.
Thank you, Noel. So I'll bring Paul into the conversation. Now, Paul is someone very much in the know when it comes to what's going on in the media, internationally, obviously, and in Portugal. Can you give us any further insight on what you have seen with people who maybe haven't followed this issue?
Yeah, I mean, over the last 18 months, 2 years, you referenced the Swedish couple that made the Portuguese news and various other channels, and shock to the system there for that particular family. But in reality, what we see over and over and over again, people leave it so late, and when they do, they have to put some money away for a period of years to build up a pot, if you like, in a way that's in a more tax efficient environment. And some people just think they'd rather be enjoying life, but it can have such a major impact on you in year 11. We've seen, I had an example of somebody who was working with a wealth manager, and they were actually a Gold Cup in Portugal, and they were sort of saying to someone about how much tax they'd saved under NHR and all the rest of it. But they hadn't done any planning, and they said, well, what's your plan for year 11? And they hadn't had one. Now, lucky it was year 6, so they were able to do something about it, and build up, a situation where they could control that, and then get to that particular example. They were able to do it in such a way that, for in broad terms for the next 10 years afterwards, because they were only paying tax on the upside of this structure that had been put forward. It wasn't material, somewhere between 5 and 10% tax, which is a big difference than 28 or 48% tax.
Absolutely, Paul. Absolutely, good point. Niall, from your experience as an international wealth manager in Portugal, I assume you're an NHR tax holder yourself. Do you have any examples where people have really made this work for them beyond what Paul has already shared with us?
Yeah, I mean, we've been able to help quite a number of clients sort of navigate again the post NHR landscape. I guess one that I could try and drop on a little bit without giving away too much confidential information was there was a husband and wife that had moved over from the UK, certainly within the last couple of years. Their assets were typically pension based, given that it was the right approach, certainly, or historically has been the right approach to put monies into UK pensions. Similarly, UK style ISAs as well, and also UK property. So it's a fairly sort of standard client position that we would normally see. And I guess the first sort of bit of work that we normally do is more of an education piece, is really to explain what works here and what the impact is going to be, again, post the NHR that we keep talking about. And quite often they're very surprised to hear that, traditionally the thing that we'd look to do would be utilize the pension drawdown facility to take advantage of the NHR to ensure that effectively post NHR drawdown was limited and that we weren't exposed to the progressive income tax rates that Joanna kindly mentioned at the start. Also looking at the dividend situation with regards to ISAs. One of the things that we're keen to do prior to anyone moving here is to really close the ISAs if you can, because they're not really efficient in Portugal. And certainly from a property position as well, you kind of want to do that certainly during the NHR period due to the double taxation agreement rules and those types of things in place. So again, it's a consideration of their particular. One thing we haven't talked about is their lifestyle requirements. So it's just financially based and driven for the conversation here. But everyone's situation is a little bit different. But in terms of a tax efficient saving vehicle, then again the best place for these excess monies or excess capital to be diverted to would be into the bond itself. So. It's a fairly standard case. The hardest part really is making sure that people understand the concept as the whys, the reasons for doing it, and to make sure they're comfortable with, with all the other things that come along with it. So the investment piece as well, and the support of the advisors and the providers that we would recommend.
Excellent. Thank you for that great insight, Niall. I don't know if we've lost Paul. Paul, are you still with us?
No, I'm still here. I just was.
Oh, you can. Sorry, your camera's back on. So I'll come to you, Paul. So just make sure you're still with us. So obviously, Paul, given your experience working with expats and investors in Portugal, what sort of trends are you seeing? As I know that you're also obviously the founder of Portugal Investment Owners Club, also known as the P Club for short. And I know that there's been a lot of great economic stats coming out of Portugal at the moment in terms of investor confidence in the country and how inward investment and certain sectors in Portugal are really outperforming international markets. And what our audience might want to consider for the long term, again, as I believe there are some great tax advantages to investing in the P Club and alternative investment funds in Portugal. Obviously, we discussed particular those insurance bonds and wrappers, as Niall has mentioned earlier.
Yeah, I mean, I noticed there's quite a few questions. Obviously, one particular question I note in the chat before I come to my answer was about US connected citizens investing in bonds, and can people go direct to the companies selling these products, well, you have to have an independent advisor. They won't sell you the product. They only deal with wealth managers and independent financial advisors. And US connected citizens can invest, and I'm sure our tax advisor will be able to give more detail than what I can give. But I'm pretty sure that providing they're QEF qualified and compliant, then they still can invest in alternative investment funds, which are, I believe, very tax efficient in Portugal, and they can invest in bonds providing they have got that QEF qualification. And we are getting inundated at the moment with what's going on in the world, with people wanting to come to Portugal, and obviously for life reasons, but they want to understand and make sure that they're not going to get penalised by coming to Portugal from a foreign country, whether it's the US, UK, South Africa, Europe, Asia, whatever. But Portugal is punching above its weight. It's the forecast coming out on the Eurozone, Portugal is outperforming the likes of France and Germany and the UK. Inflation in the last 2 months has been decreasing, whereas in North America and Europe and the UK, it's been going up. So it is, investor confidence in Portugal is at an all-time high, that's for sure.
Thanks, Paul. Going back to sort of Niall and Joanna, what could someone on the old NHR tax regime, whose main source of income is their non-Portugal derived pension, do to sort of mitigate those sort of future tax burdens we've all been talking about? Joanna, I'll come to you first.
Well, Steve, I think it, of course, it depends always on the specific situation of each individual, and also of the flexibility of the pension plan that we are analyzing and discussing. But as Niall was saying and mentioned the bonds, and I think it's also something that's very popular here in Portugal, and we also like to analyze and recommend to the clients the unit-linked policies, not only for taxation purposes, but also thinking ahead for succession effects. And it's also something to consider and something important to the client. So I would say it depends on that, but a good idea, if we are looking just to pension income and those types of pension funds and plans, if not possible to transform it and to maintain those type of income and to qualify it as such, maybe, as Niall was saying, trying to withdraw as much as possible and take the advantage of the NHR while in force, and then to use for the future and think and other solutions, other alternatives. Paul also mentioned the alternative investment funds. Of course, it is something very interesting in Portugal from a tax perspective. It's more detailed and it's not feasible to everyone. But I think we do have alternatives, and if not possible to keep the same structure, and that would lead to the qualification of the income still as a pension. That's why it's important to have time to do anything right now or in the near future, to then be able to use this income and to structure in the best way possible to then take advantage of this type of products. I think the unit linked, it's very popular and it works very well.
Thank you, Joanna. Niall, anything to come in behind Joanna on that?
Yeah, just really to back up what Joanna was saying, really. Again, if you're looking at purely a sort of pension-based situation, if there's a situation whereby the client can afford to draw down excess above their sort of desired income level, it really doesn't make sense to do that post NHR without having an alternative vehicle in place, as you will be exposed to the progressive income tax rates predominantly on that amount. So yeah, you really want to try and look at ways in which you can reduce that pension size, and then in effect divert the excess income or capital, replacing it into into this alternative structure, and then drawing it down from this structure, when the NHR period ends.
Excellent. Thank you, Noel. Thank you, Joanna. Now, I can see that over sort of 90% of the people on this webinar are existing NHR tax holders from the survey, obviously from the old scheme. But if they're not, what does the new IFICA tax regime that's just come into play for new people offer that's maybe different to that of the old scheme? And again, I'm assuming you can't obviously be on both NHR and IFICI. Joanna, perhaps you could take this one for us?
Of course, Steve, and yes, it's not possible for current NHRs or old NHRs to take advantage of this new tax incentive regime, the IFIC. It's not possible. But I think the biggest difference here, and of course, I will not get into the criteria to access this regime. It's the biggest difference. NHR was very simple, very straightforward. It was easy to explain to the clients what it's needed to comply with to have access to this regime. And this new tax incentive regime, it's not the same, and it's much more focused for active individuals, or either under research and innovation matters here in Portugal, or looking to corporate companies here, startup companies trying to develop here a business activity. But in terms of taxation, I think it's the easiest way to answer now. The big difference would be on the positive note, the taxation regarding capital gains, foreign sourced capital gains, that under this new tax incentive regime benefit from a tax exemption in Portugal. It was not like that under the NHR. It was not that straightforward. And on the downside, the pension income for sure, regardless of the source of this income, if we reach the conclusion that it's going to be qualified as pension income, then the new tax incentive regime will not be applicable, and it will be subject, this income will be subject to taxation, and most likely to the progressive rates, as we have been saying until now.
Thank you, Joanna. I can see obviously we've got a lot of questions coming into our Q&A, and we'll be starting the Q&A very, very shortly. So one last question before we move on to those audience questions. Can the panel give us the sort of key steps that they need to take now to plan early and mitigate those future tax burdens post NHR tax status? Niall, I'm going to start with you and then just go around the room.
Okay. I guess the key things would be to understand the composition of your assets. So how is your income generated? How is it structured? How are your investments? How's your capital structured? That would probably lead you to putting like a sort of statement of assets and liabilities together with corresponding income. From there, analysing what the impact would be post NHR, and finding out what you don't like and seeing if there's any alternative options. So that's probably on the sort of facts and figures side of things. The kind of softer stuff that we also need to talk about would be what the plans are for the clients towards the next sort of 5, 10, 15 years. A lot of the people that came here, they're wealthy individuals, quite often have business arrangements still running, and therefore they might look at what the issues would be or complications with moving jurisdiction again. So again, it's one of the things that if we're putting a structure in place, we have to be aware of what the plans are sort of longer term, what the income needs will be at those various points, how it will be funded. And again, going back to something that I mentioned at the start would be the sort of estate planning, succession planning aspect of these things. Again, once you start getting into some bigger numbers, that actually becomes very, very important for people with regard to both taxation and inheritance laws. I guess the final takeaway on that question for me, Steve, would be it probably won't come as a surprise that, in my opinion, it's definitely worth its weight in gold speaking with someone like Joanna to understand the tax position, and then laterally looking at what can be done from an investment wealth management perspective. So really getting some proper advice on each individual circumstance, I think, is very important.
Thanks, Niall. Joanna, anything you want to come in, obviously behind Niall with regards to that before we get to the Q&A?
Well, I completely agree. I think it's just start now. I would say it's never too late. I think, and it's important to understand the client situation. It's always different. To not to be afraid to understand exactly the impact for the future. So if anything, if it's possible to do anything about it, it's much more preferable to do it with time, not to be in a rush. And of course, it's important to have this component of the tax analysis and framework, trying to understand the applicable rules to the future, navigating not only the Portuguese tax system, but also from an international perspective. And this is from only the tax standpoint, but of course, understanding then how can we do this? Is it possible from a financial perspective? So what is the client's intention for the future? Which are their goals? What is their main concern? So I think this joint analysis is very important, and just start with the meeting with an advisor that can help and assist navigating throughout all these matters, and then make a decision. So if something is needed to be done, let's do it. If not, trying to anticipate any future tax bill and to know what is coming.
Thank you, Jan. And again, to our audience, anybody out there who's got any concerns or that they haven't started that all-important sort of early planning, please obviously drop a note in the chat, and our team will pick up that message and will align you with the right expert to help. Or obviously just then there's more information on this on our website. Again, please visit our website to sort of further your research. Now we're going to come on to the questions now.
Steve, I just wanted to comment on
okay, no, sorry.
Yeah. So yeah, in relation to, one of the things that I've seen work quite well, because obviously every tax, you've got cross-border tax considerations here, and double taxation agreements, and US connected citizen type folks, have to have a very different type of conversation than someone from most other countries. But I find if you can get your tax advisor working very closely with a trusted wealth manager or independent financial advisor, like Niall, if you can get them working collegiately, you can get much closer to where you want to be and get that peace of mind. Because sometimes if you do it in isolation, it's not always joined up, and that's where we've seen people in terms of taking the process. And Portugal Pathways is very happy to facilitate setting that up.
Absolutely. Well said, Paul. Well said. Okay, so yeah, we've just come to the questions. I can see obviously we've got a number of questions in the chat. We'll try and get to as many of them as we can within the next sort of 15-20 minutes or so. And I'm going to start with Mark. Mark is asking, and Niall, I'm going to put this one to you initially. So Mark is asking, I'm in year 6 of my 10-year NHR. I've been paying 10% on my UK pension under NHR and little or no tax on dividends from my UK holdings. I spoke with a friend who told me that this issue of progressive tax rates, and he said he'd taken advantage of the bond that had been in place in year 5 and estimates that he'll be paying about 5 to 10% overall tax on the bond. So how does this tax work? And obviously, he's saying, is this correct? Quite a long question. I hope you got it all.
I'll do my best. When it comes to these types of things, usually I think it's best sort of described with a sort of an example or an illustration. I think you can get a better feel for how these particular structures work. So very generically, very loosely, obviously I don't fully know of Mark's individual circumstances, but if we were to, and this will probably, the illustration will touch upon some of those aspects that Mark's kindly mentioned there. If we look at, let's say, a typical client would have, if I pull a figure of a million per se in this particular bond structure, well, firstly, it's completely open-ended. So there's no tie-in period. There's no holding sort of pattern that you need to have, depending on the underlying assets, which sort of talked about earlier. You know, historically would be a mutual fund situation or an ETF situation. Then it's fully liquid and fully accessible. Now, if we assume that again, it's got a million in this particular structure, and if he holds the bond, let's just say in this example for 1 year, the underlying investment portfolio creates a return of 10%. Well, again, as I mentioned at the start, firstly, that any gains whilst sort of within the bond structure is completely outside the scope of any tax, both in Portugal or indeed any other jurisdiction at that stage. So there'd be no tax to pay on that or gain. So if we're looking at 10% based on a million, that would be 100,000 euros worth of gain. There is a, let's say, like I said at the start, a tax consideration. So if we assume that after the first year, for example, the client then makes a withdrawal request, let's say again that he looks to make the full 100,000 withdrawal, well, that's paid gross to the client. The tax consideration, well, this is how it works more or less in Portugal, is it looks at, let's say, the holding period return. So in this case, it would be the 1 year. It is 10%. It then applies the same growth period growth return, to the withdrawal consideration, which is 100,000. So there would be a 10,000 tax consideration. Now, the taxation element of the bond in Portugal, for the first 4 full years of the bond's life period, then it's taxed at 28%. So if we're looking at this 100,000 withdrawal, 10,000 is the tax consideration, then you're looking at a 28% tax rate on the 10,000, meaning a tax liability of 2,800 euros on a 100,000 gain, 100,000 withdrawal. If you hold the bond and make withdrawals from periods 5 years from 5 to years 8, then it reduces to 22.4% on the taxable gain amount, and then indeed it levels off at 11.2 from year 9 onwards. So I think you kind of quoted a couple of figures in the question, Steve. So it's fully realistic to achieve some of those taxation numbers, and you know, you don't need to be too quick-witted to work out that you know, 11.2 on the taxable amount is considerably lower than any 28% or progressive income tax rate that you would normally pay post NHR period. So I hope that's answered some of the questions on the bond for Mark.
Yeah, that was a very good analysis. Thanks, Noel.
I mean, the bottom line of that, it's it's 10% and then 28% of 10%. So it's a tiny figure in reality, isn't it? On the upside in that example.
Yeah, and that's assuming a full withdrawal, and it's assuming a 10% growth. Clearly, if the growth's going to be smaller, the tax element of it is also going to be smaller as well. When I say 10%, you know, that I'm just giving a illustrative figure on that. What will actually happen will be, you know, determined by the performance of the investments itself.
Yeah, of course.
Absolutely,
course.
Absolutely. So, I've got Matthew, and Matthew is asking, he's saying, what is the likely cost benefit in relation to retaining someone like RFF on the tax side and Beacon Global Wealth Management on the cross-border strategy? So I don't know, Joanna, you can initially sort of answer that, and then Niall can sort of give his take on it.
Of course, Steve, and I will just follow up on Niall's answer because I think it proves very well why it's important and it's useful to have this kind of joint analysis. Because one thing, and as I explained, is to have this tax assistance, and of course we can do that. And RFF Lawyers is very focused on taxation matters, and within the private clients team, we combine, of course, taxation matters with the immigration side. It's not possible to separate those matters within the relocation process of the client, of course. And so we handle this type of analysis on our daily basis, and we try to explain and to understand first the client situation and to explain exactly how everything works to the client. But then when it's needed to take a further step and trying to figure out and to propose something and explain something to the client that is going to be much more tax efficient. So most of the times it will be needs or it's good to have someone like Niall and can advise as well and do a joint collaboration. So trying to explain to the client which will be the tax impact and how to do it. So it's very important to have someone on the other side also helping to navigate all those matters and who we can rely on to assist the client for the most complete advice possible.
Thank you, Jay. Niall, anything to add on that?
Yeah, I mean, when we talk about cost and benefit, it's difficult to put a number on these things. My answer would be yes. there is a significant cost benefit. How I would best describe that would be along the lines of it's very likely impossible that the tax lawyers, tax advisors will know considerably more around the taxation system, not just of Portugal, but also of the home jurisdiction as well, and how those two interplay. And they'll know some of the areas that you want to avoid, and also some of the areas that you want to take advantage of, that probably, unless you've been in that environment, the client won't know. And those can result in real savings. So in my experience, it's very, very beneficial to work sort of hand in glove with tax lawyers with regards to that. In terms of our services, then one aspect of it is generating the returns. So again, that can actually look like real figures for people in terms of the investment side of things. And that's very monetary focused. The other aspect that you can't really put a price on is the peace of mind. So the clients that we have, again, who come here, they're busy doing other things, or they've came here to relax and retire. They're probably not so much inclined to be managing their own affairs, and whether or not they're managing it diligently as well. So having someone like Joanna and her team, or someone looking after the advisory aspect of the investments as well, really just gives them the peace of mind, which I think is certainly worth doing on its own.
And I'd reiterate, if anybody's unsure, because the reality is we all live more complex lives, we all travel more. Unfortunately, we have more divorces and second children and all of the many things that go on in the modern life. It's just really important to just get that sense of where you want to be and how you get there. And Portugal Pathways are very happy to set up an initial call to help sort of understand that, and then bring in the tax and the wealth managers relative to that, that understanding.
Excellent. Yeah, absolutely. Yeah. In the end, if you want to sort of reach out to us, again, we'll obviously understand your sort of specific situation, and again, we can advise if a dual call, if you like, with an RFF and a Beacon Global is advisable in the first instance. I think we've already answered this question, but it's come in again from Kirsty. So, Paul, I'm just going to ask you to give your sort of understanding on this. And Kirsty's asking, why do I need advisors? Why can't I just buy one of the insurance bonds myself directly?
Yeah, I believe, and I'm pretty certain on this one, that the companies that sell these products sell them exclusively through independent financial advisors because they can't sell their product direct to the public, and that's part of the compliance thing to make sure that somebody is looking at that product to make sure it's right and relevant to the client. So you can't buy it directly, even if you contact them. They'll just put you in touch with an advisor. And I saw another question sort of interlinked to this about are these bonds safe, and are they? I mean, some of the organizations that run these bonds have huge funds under management. I mean, I can think of one that has well over 250 billion under management, and Niall can probably talk a little bit more about how secure these things are.
Yeah, so just to echo what you said, Paul, because it's a regulated product and given it from a financial advisory perspective, it's not something that the clients can go directly to the providers and access. It has to be done through regulatory channels and intermediaries, such as ourselves or others that operate within the same grounds. In terms of the protection mechanisms, then they will be supported by the jurisdictions that they're based. So there will be some compensation should anything go wrong. And there's also segregation of assets from the providers and from the banks. Typically the monies will be held in a custodian account for the owners of the bond. But no, it's from certainly comparing it to a UK position. It's not too dissimilar to let's say like an offshore bond or something. If any of the audience is familiar with that sort of background. But yeah, it's something that we could certainly discuss in more detail.
I mean, in reality, if you take the UK example, ISAs are the standard fare in the UK, but bonds are the product of choice in Europe in the main. Obviously, alternative investment funds is another option and equally very tax efficient, but in a different way.
Thank you, Paul. Thank you. Again, a couple more questions I'm going to come in before we sort of wrap up today's webinar. This one is, Joanna, I'm going to ask if you can take this question. This is from Sarah, and Sarah is asking, she has rental income from abroad through a company that she set up. Will this be taxed differently after the NHR ends? And what can I do to manage this effectively?
Well, I think in Sarah's scenario, as I understood, the property is held within the company, so it's not actually a matter of analyzing itself the rental income arising from the property, because it's going to be generated within the company sphere. But thinking most how to then arrange the profit distribution to Sarah's, not just as a payment, as a dividend payment, but kind of other solutions that we have. And it can be interesting to explore how to mitigate the proper tax impact within the company sphere, and not only considering the individual sphere. So in this sense, the rental income is going to be taxed within the company sphere, and then we need to understand exactly which is the best way possible to withdraw this money from the company to Sarah, that it's not exactly, or if it's besides the option of receiving just the profit distribution, that is going to be qualified as dividend. And so under the NHR can be good, but post NHR, it will most likely not be. But we have also here interesting options and regimes that can be applicable depending on then the company itself, and that can help mitigate and reduce tax burden.
Great. Thank you, Joanna. One final question, just before I get everybody to give their sort of key takeaways. We just sort of finish up with some closing remarks. This one is from David in Lisbon. And he is saying he's a US connected citizen with NHR. He still has taxes to pay to the US Treasury forever, but he's heard that he has to be careful of investing in alternative funds in Portugal because of PFIC rules that only apply to Americans. Can anyone explain to him how qualified elected funds, QEF, rules work and why they're important if he was investing in Portugal as part of his post-planning NHR? Now, that is a long question. Paul, I'm going to push that one to you because I know that you've had some experience with some of American investors that have invested through the Portugal Investment Owners Club and some of the Golden Visa Residency by Investment Alternative Investment Funds in Portugal. So I don't know if you can remember that question because it's quite a long one, but
yeah,
I'd like
to I saw it in the chat earlier and was hoping you would point this one in my direction. So yeah, I mean, this has come up a lot recently because we onboard a lot of people through Golden Visa Residency by Investment from the US. And it is important that in the management regulations that are filed with the CMVM regulators in Portugal, equivalent to the SEC in America, that basically the fund has those QEF rules in there because you can't do them after the fact. They have to be built into, and there are funds out there that are protected. So, because PFIC is fine for anyone in Europe, but because of the way the US Treasury works, you have to have these QEF rules baked into your management agreement with the regulators. And it would be the same with other forms of investment, although direct investments into private equity, is less troublesome. But it's more than possible if you get the right advice and you've got people checking that out. So I'm sure people like Joanna could help with that. But again, if you come through to Portugal Pathways, we'd be happy to look at what you've got and what you're considering and make sure that you don't fall into that trap. Often it's called the ghost tax. So what the Treasury does in America, say you've invested in a Portuguese fund, because it isn't the responsibility of the Portuguese fund for you to check your own tax. So they don't have to do it, but we feel morally they should. When it comes to the end of that year and it says that your fund has gone up on paper at the end of year report that's filed saying that it's gone up by 10% and you've got $1 million invested, so 100,000, like Niall's example with the bond, but with a fund. If that's gone up 10%, the US Treasury will charge a 37%, up to 37% ghost tax on the invisible sum invested in that fund in terms of the upside, even though you haven't realized the liquidity of that 100,000 upside. So if you have it in the QEF qualification language, then it avoids that. I mean, Joanne might have more knowledge of that beyond that, but I hope that makes sense.
Joanna,
I think you've explained it well, but it's always something interesting to analyze regarding U.S. Citizens and trying to understand how the U.S. will apply all of these, protect all these rules regardless and despite the tax treaty we have. So I think you explained it well, and of course we can because everything is different. I think it's useful to have this chat, and anyone that's interested, we can do that and we can arrange that.
Absolutely.
Yeah. And we can make sure that we've got US tax experts that can work with Portuguese tax experts, so you can get to the right place and not have full fail of unintended consequences. So
completely, it's very important with any jurisdiction. I mean, but especially with the US. So of course we can understand how it works and explain to the clients, but it's something that needs to be carefully analyzed and explained to make sure that tax impact in the US it's known and if it can avoid it or not, how to do it, because we can understand anything because it's of course connected with our work, but local advisors, it's always something that it's much needed and recommended to work, everyone working together.
Absolutely. Thank you. Thank you. So we have just gone past the hour mark, and obviously quite clearly we haven't got to all of the questions today. So our team will be going back to those individuals who asked questions via email, just to obviously pick up on any points that you may have. But before we sort of draw a close to today's webinar, I just really want to go around the room, speaking to each of you individually, as in the panelists, to really just get sort of one key takeaway, obviously related to planning early and getting ahead of the game before NHR tax status expires. So, Paul, I'm going to start with you.
Well, I'm going to use one that we've used before, is think like you're Portuguese, act like you're Portuguese because you're in Portugal. And if you're somewhere on that 10-year journey of NHR, then, you know, you'll be thinking about the long term, not the short term. And if you act early and get peace of mind through talking to the right partners, then, you know, there's no reason why you can't enjoy, you know, a sensible or low tax environment beyond NHR.
Thank you, Paul. Joanna?
Well, adding to what Paul mentioned, it's just the consequence. It can be very expensive then to the clients, because in Portugal, if you do not report your income properly, if you do not plan ahead and trying to anticipate which will be the tax impact and your tax bill at the end, if then you want to solve it, it will need to first pay to the tax authorities, and we'll need to initiate all kinds of procedures, administrative and even judicial, to try to get to the point that you want to, and that you could just do it if you plan ahead.
Lovely. Thank you, Joanna. And finally, Niall, just leaving you to the final points.
Sure. To try and tie it in with what you said at the start, then it would be, my final takeaway would be a question back to the audience about what's your plan post NHR. If you don't have one, then you should get one. If you do have one, then you should get it reviewed to make sure that you know that it's appropriate and it's the most efficient plan that you can have post NHR.
Lovely. Great. Great takeaways, and I obviously echo them all. So thank you for those. Obviously, the message is pretty clear. You know, early action is crucial for peace of mind, and obviously choosing the right professional partner to suit and to support you. Obviously, we encourage you to sort of book one-on-one, sort of no obligation consultations with our experts to discuss your personal situation. It just really leaves me to say a big thank you to our panelists, to Paul, to Joanna, and to Niall. A big thank you to our audience, obviously, for attending and taking time out your busy diaries today. Our next webinar, as you can see on the screen, is on the next week, on the March the 18th, and it is entitled "The Impact of Portugal's Golden Visa Residency by Investment." So if that appeals or applies to you on the call today, please again just click on that link and register for next week's webinar. Just leaves me to say a big thank you again to the panelists and to the audience for joining us, and we will see you soon. Thank you very much.